All right, everybody, what's up? It is Thursday, May 28th. So, here we go. I still do not see any sign of a pickup in the tax flow data. Now, again, I look at this stuff every single day. It comes out every single day off of the daily treasury statement. This information is real time. This is not like looking at government release data that comes out every 30 days. And I've been on this every single day looking for even the slightest evidence just stabilizing. I'm not even talking about a turnaround or a reversal in the deceleration in these tax flows. And specifically, I'm talking about the employment and withholding tax deposits to the Treasury. That's tied to employment, tied to jobs, tied to people working. It was very clear when this thing broke down in March that the economy was in trouble, and we knew it because of the lockdowns. It was showing up very obviously in the data. So I'd like to see at this point, with the lockdowns ending and economic activity starting to resume once again, some evidence in these tax flows that things are starting to pick up. I do not see it. Now, it doesn't mean it won't happen. It might take a little bit more time because the reopening of the economy is happening step by step. It's not, flip a switch and we're back to where we were. But I mention this in the context of the stock market rally. As you know, I was saying buy the crash back in early April. I said at that time the market had, the big drawdown in the market had already discounted the negative impact we would see to the economy. And I said new variables, right? I've been talking about this a lot, new variables. Unprecedented amount of fiscal stimulus, monetary support, and eventually getting to the point where we flatten the curve and the economy would slowly start to open back up again. The lockdowns would be lifted. So, the stock market discounted the collapse in the economy with the big correction that we saw. Then the rebound was in response to the new variables. But now, and I spoke about this the other day, everybody was waiting on the sidelines, not us. We got in at the bottom and we rode this thing up. But now, those who, they wait. And I've done a number of videos on this about the irony of the situation that they wait when they should be in. And when they're in with a good position, they don't wait, they get out. But now they're jumping in, and I do not see any evidence in the data that we are getting an improvement, at least on the labor side, on the employment side. And that's important because that is going to have an impact on demand. Now, fiscal support is enormous. We are up now almost 970 billion over where we were last year in terms of spending, and last year was a record year. We are already up just to give you some perspective, last year at this time, we were up around 200 billion over the previous year. And as I said, last year was a record spending amount. Now we are up 970 billion over last year, and we still have 4 more months left in the fiscal year, right? June, July, August, September. So fiscal is enormous, but what's happening, and you could see it very clearly, the money the government is sending out to people, for the $1,200 payments, the unemployment benefits, the payroll protection, that sort of stuff, it's going into bank deposits. It's going into savings. A lot of it is not getting spent. By spent, I mean the demand is just not there in the economy, and that's what we need to see. So I think, and by the way, technically, if you look at the market, some indicators such as the put-call ratio, if you look at the 10-day average of the put-call ratio right now, it is the lowest since mid-January. Remember, when that thing gets low, it's well below 1 when that thing gets low, it indicates a higher volume of calls relative to puts. So it's generally an indication that people are more optimistic. Now that thing was way high. It was something like 180 or 160, when the market bottomed, meaning that the volume of puts was enormous. People were so bearish at the bottom. That was another reason we got in long the market. Now it's the opposite. More optimism at a time when really not seeing any evidence of a pickup in economic activity. So I'm saying market looks a little bit speculative here. It looks a little risky. Probably due for a pullback. And then we'll have to take a look. I mean, at some point, you would think that it's going to start to show up in these tax flow data that we're seeing a turnaround in economic activity. But right now, I have to tell you that that is not happening. I think investors who are coming into the market now, who waited and who didn't buy in early April, who sat on the sidelines or stayed bearish or even shorted the market, they're turning around and they're coming in now. And now is a time when the picture looks a little more risky to me. So playing for a pullback here, and we'll see what happens after that happens. We'll see if we get the evidence that we're looking for an economic turnaround. I sent out the weekly EIA petroleum status report today, the analysis on that. Kind of neutral to, I would say, leaning bullish. Still a very disturbingly high level of crude oil inventories. Gasoline drew down by a fraction. Very high level of distillate inventories. Gasoline demand picked up. Distillate demand was weak. Anyway, it's all in that report. If you want to get a copy of that, go to my website, pitbulleconomics.com. Sign up for a 30-day free trial. And you can click on the link right here below to do that. See everybody tomorrow. Bye.